Liquidity is not a side issue in 2026. It is the difference between staying invested and being forced to sell, between absorbing a job shock and borrowing at the wrong time, between patience and panic. Rates are still meaningfully positive. OECD inflation is lower than the peak years, but prices remain a top concern. U.S. unemployment was 4.4% in February 2026, and household debt reached $18.8 trillion at the end of 2025. That is why the right emergency fund is not a generic 6-month slogan anymore. It is a risk management position sized to your actual exposure. Here is the first correction you need to make. An emergency fund is not idle money. It is not your lazy bucket. It is your personal liquidity reserve, and liquidity has a job. In markets, liquidity gives you time, protects you from forced liquidation, and lets you respond rationally when volatility rises. In your life, cash does the same thing. It protects decision quality. Most people misunderstand this because they compare emergency cash to the potential return of stocks and conclude that holding cash is inefficient. That comparison is too shallow. The real comparison is between modest foregone return and catastrophic forced selling, expensive debt, or a broken financial plan. So, when you ask how much cash is actually enough, you should not start with income. You start with failure points. What can interrupt your cash flow? How quickly could your expenses reprice? How much of your life is fixed, and how much can be cut fast? How dependent are you on bonuses, commissions, freelance work, stock-based compensation, or one employer? The operating mechanism matters here. In markets, prices are driven by liquidity, rates, volatility, sentiment, and positioning. In your life, emergency fund size is driven by cash flow stability, fixed obligations, debt costs, dependence, income variability, and how quickly your assets can be accessed without damage. That is the biological mechanism of household resilience. If those variables are unstable, your reserve must be larger. This is why a flat rule like 3 months for everyone is lazy thinking. 3 months might be enough for a stable dual-income household with low fixed costs, little debt, strong insurance, and high employability. It may be dangerously small for a self-employed household, a single earner with dependents, a commission-based professional, or anyone carrying large fixed obligations. In the Federal Reserve's 2024 Household Survey, emergency savings measures improved only slightly and remained below 2021 levels, while inflation and prices were still a top concern. That tells you the environment is more fragile than the average person wants to admit. So here is the framework. If your income is stable, your fixed costs are low, and your skill set is employable in a liquid labor market, enough cash may be 3 to 4 months of true expenses, not idealized expenses, true expenses. If your income is somewhat variable, or you support children, or your household depends on one main earner, enough cash is closer to 6 months. If you are self-employed, highly cyclical, concentrated in one volatile industry, or your lifestyle has high fixed costs that cannot be reduced quickly, enough may be 9 to 12 months. And if your balance sheet contains hidden fragility such as tax exposure, private debt, uninsured risks, or illiquid assets, your reserve may need to be larger still. Enough is not a number that sounds disciplined. It is the amount that lets you survive your likely disruptions without breaking your strategy. Now apply that tactically. Start by calculating monthly burn rate in 2 versions. First, the hard floor. Housing, utilities, food, insurance, minimum debt payments, medical basics, transportation, childcare if unavoidable, and non-negotiable obligations. Second, the real current burn. The full lifestyle you are actually running. The gap between those numbers tells you how much flexibility you really have. Most people skip this and say they have 6 months of reserves, when they actually have 6 months of a stripped-down fantasy budget they have never lived on. That is not a reserve calculation. That is wishful accounting. Then run your income stress test. If your pay is fixed salary and historically stable, you can size to a shorter disruption window. If your pay depends on commissions, deal flow, contracts, tips, performance pay, or equity compensation, you size to a longer window because volatility is built into the system. If payroll is softening, if your sector is cutting, or if your company is exposed to weak demand, you add more cash, not less. February payrolls edged down by 92,000 and unemployment held at 4.4%, which is not a crisis signal by itself, but it is enough to remind you that labor conditions can soften while people still talk as if everything is normal. Your emergency fund is supposed to be built before the softness becomes visible in your own paycheck. Next, look at liabilities. If you have high interest debt, your reserve decision becomes more nuanced. Most people either hold too much cash while paying punishing interest, or they throw every spare dollar at debt and leave themselves exposed. You do neither. You build a minimum defensive reserve first, then attack toxic debt, then continue building toward your target reserve. In other words, your first layer is shock absorption, not perfection. If you eliminate all cash to optimize debt payoff, one emergency pushes you right back into borrowing. That is not deleveraging. That is circular fragility. Where should the money sit? In instruments built for survival, not excitement. The first layer belongs in a safe checking or savings structure that you can access immediately. The second layer can sit in high-quality cash equivalents or short-duration vehicles where principal stability matters more than return. If you are stretching for extra yield in assets that can swing when you need the money, you are no longer running an emergency fund. You are running a correlation risk you forgot to model. Ready.gov still advises households to keep a small amount of physical cash on hand because ATMs and cards may not work during some emergencies. That sounds old-fashioned until payment systems fail exactly when you need fuel, food, or transport. Now bring markets into the picture, because this is where people make bad comparisons. If the market moves sharply higher while you are still building your reserve, you do not panic and redirect emergency cash into risk assets just because you fear missing upside. If the market falls, you do not liquidate your reserve to buy the dip unless you have already exceeded your required liquidity target. Emergency cash is not tactical dry powder until it is above the emergency threshold. Below that, it is structural capital. This distinction is everything. If you ignore it, you will keep telling yourself you are being opportunistic when you are really just underinsured against your own life. This is where most people stop, but this is the advanced level. The advanced level is recognizing that emergency fund size is not just about months of expenses. It is about second-order effects and correlation breakdown. Job loss does not arrive alone. A weak labor market can arrive with falling bonuses, weaker freelance demand, market volatility, tighter credit, and higher stress inside the household at the same time. Home repairs do not arrive in a vacuum. They can arrive while insurance premiums rise, while a child needs care, while your car fails, while your employer delays promotions. The mistake is assuming shocks are independent. In real life, they cluster. That is why a reserve that looks excessive in calm periods often turns out to be merely adequate in disorder. If your income falls, your portfolio falls, and your access to cheap credit tightens at the same time, your emergency fund is the only asset in the room whose job is not changing. That is personal portfolio ballast. It prevents liquidity traps. It prevents you from selling productive assets into weak markets. It prevents you from financing a temporary problem with permanent damage. Household bankruptcy math is not complicated. Fixed costs rise, liquidity falls, credit gets more expensive, and a short shock becomes a long one. Cash interrupts that sequence. You also need to watch the behavioral trap. Once rates are positive, people start talking as if cash has become an investment. That is not the right framing either. Yes, higher short-term rates mean cash is less punishing to hold than it was when policy rates were near zero. The Fed's target range is currently 3.5% to 3.75%. But do not let that turn the reserve into an excuse for hiding from long-term investing. Cash is a tool for time, not a substitute for growth assets. Your reserve protects the portfolio. It is not the portfolio. So here is how you size it in sequence. First, define the floor budget. Second, classify your income as stable, variable, or cyclical. Third, measure fixed cost ratio. Fourth, identify dependence and uninsured or underinsured risks. Fifth, evaluate industry and employer stability. Sixth, check whether you have backup liquidity that is real and cheap, not theoretical and expensive. Seventh, choose your target reserve range. If your system is strong, you can live near the lower end. If your system is fragile or exposed to multiple risks at once, you move to the upper end. Enough cash is the amount that lets you handle a realistic stress event without selling long-term assets, missing critical payments, or losing control of decision quality. Then you build it in layers. Your first layer is immediate access cash for true emergencies and payment friction. Your second layer is the core reserve for job loss, income dips, and major disruptions. Your third layer, if needed, is strategic liquidity for highly variable earners or families with concentrated risk. If you are still early in wealth building, the first layer may be small but non-negotiable. If you are a higher earner with one volatile source of income, the second and third layers matter far more than they do for someone on a stable salary. That is why copying other people's reserve size is dangerous. You are copying their risk structure, not just their number. Now test the logic under pressure. If the market drops 20% tomorrow, can you continue investing without touching reserves? If your employer cuts bonus pools, can you run your household for several months from cash without adding debt? If your industry freezes hiring, can you buy time for a better decision instead of taking the first weak opportunity? If your answer depends on probably, your reserve is not sized, it is guessed. To practice this skill, journal your reserve assumptions. Write down why your target is what it is. Note your floor spending, your current spending, your income type, your biggest correlated risks, and the assets you refuse to sell in an emergency. Then reverse test the setup. Assume income falls 25%. Assume expenses rise 10%. Assume the market is weak. Assume it takes longer to find work than you expected. If the plan still works, your reserve is closer to real. If it fails quickly on paper, that failure is a gift. Paper is cheaper than crisis. Maintain the system with an evaluation loop. Recalculate the target when one of four things changes: your fixed costs, your income stability, your number of dependents, or your career risk. If you move to a more expensive city, your reserve target changes. If you leave salary for self-employment, your target changes. If you add children, take on a mortgage, or rely on one main earner, your target changes. If your industry becomes more cyclical or your compensation becomes more variable, your target changes. Emergency funds are not static because life risk is not static. And combine this skill with the other tools that actually make it powerful. Valuation matters because a well-sized reserve lets you invest through drawdowns instead of freezing. Macroeconomics matters because rates, inflation, and labor market conditions influence both your opportunity set and your need for liquidity. Technical analysis can help stage entries on the investing side, but only because the reserve gave you the freedom to wait. Risk management ties it all together: insurance, low fixed costs, manageable debt, diversified income, and a reserve sized to the life you are actually living. Those pieces work as one system, not as separate tips. The final mistake to avoid is treating the emergency fund as a moral challenge instead of an engineering problem. Some people feel proud holding too little cash because they believe every dollar should be working. Others feel safe holding so much cash that they delay real asset ownership for years. Both are using emotion. The right amount is the amount that neutralizes your credible threats while preserving enough capital flow into productive assets. Not more because fear feels good, not less because optimism feels intelligent. So how much cash is actually enough in 2026? Enough to survive your likely shocks? Enough to protect your long-term assets from short-term needs? Enough to stop volatility in markets or income from hijacking your decisions? And enough to buy time when time is the most valuable asset you can own? If your life is stable, that may be closer to 3 or 4 months. If your life is leveraged, concentrated, or volatile, it may be 6, 9, or 12. And if you go back through this carefully, you will notice that the right answer did not come from one rule of thumb at all. It came from one quiet variable underneath all the others: how much time your cash can buy before the rest of your financial system is forced to move.